Today, we're going to try and cut through some of the noise around private credit.
Yeah, it's a term you hear a lot.
Exactly. But what does it actually involve? We're looking at a Man Group article today that tackles 5 common myths.
Right, trying to get behind the headlines.
Our mission really is to unpack these myths, look at the strategies, the results, the theories behind them, and importantly, any potential downsides.
Give you a clearer picture. We want to separate, the assumptions from the reality using actual analysis, focusing on how it works, the logic, and what to watch out for.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, let's jump in. Myth number 1. Private credit is basically a zero-sum game. Non-bank lenders versus banks fighting over the same pie.
That's the common perception. Direct competition.
But the article suggests it's, more complex.
It's definitely more complex, often symbiotic, actually. There is competition. Banks are deeply involved.
How so?
Well, get this. About half the money non-bank lenders use for things like acquisitions, it actually comes from banks through fund finance.
Wait, half? So banks are funding their supposed competitors?
In a way, yes. They provide that capital. They offer cheaper funding lines to certain non-bank lenders. They give leverage to private credit funds. It's quite intertwined.
Okay, so what's the theory there? Why would banks do that?
It helps banks manage risk. They can offload some exposure, handle their capital requirements more easily.
Okay. Regulatory capital, maybe?
Could be part of it. And for the private lenders, it means, cheaper funding, which helps their returns and maybe lets them offer better terms.
So it's not quite David versus Goliath. But is there any direct competition? Or is that just wrong?
Oh, there's definitely competition. The article points to the middle market that think borrowers with, say, under $75 million in EBITDA.
Right.
There, it's more head-to-head sometimes. But even then, you've got bank consolidation, regulations. Banks aren't always set up to hold all that specific risk anymore.
So what's the ideal scenario then, according to this view?
The article paints a picture where private lenders, maybe with more stable locked-up capital, take on slightly different or incremental risks. And banks, using their low cost of funds, lend to perhaps lower-risk borrowers or deals with a lot of protective capital underneath them. Sort of a division of labor.
Specialization, really, not just conflict.
Exactly.
Got it. That really shifts the perspective. Okay, myth number 2. Private credit is this brand new, untested thing. It feels like it just popped up recently.
Yeah, it gets talked about like a new invention, but history tells a different story. Non-bank lending, it's ancient.
Ancient.
The article makes the point that non-bank finance goes back thousands of years, way before formal banks as we know them. Depository banking is the newer kid on the block, historically speaking.
Wow, okay. 5,000 years, they mentioned. So private credit today is just the latest version.
Sort of. Its modern roots, you could trace them back to maybe the early 80s. Insurance companies, especially finance firms lending where banks didn't.
And then the 2008 crisis. Was that a factor?
Huge factor. Post-GFC, banking regulations tightened up significantly. That created gaps.
Which non-banks stepped into.
Right. Strategies like direct lending really took off then, filling that void.
What about some of the more complex stuff like SRTs?
SRTs, strategic risk transfers. That's where banks partner with private investors, often using securitization, to manage their loan portfolio risk.
Is that new?
Not really. Been around since the 90s, apparently. And they operate within regulations. The Fed even noted in 2023 that they help banks handle credit risk.
So the takeaway is that while the market's grown and changed, the basic idea of non-bank lending and many strategies aren't new at all.
Exactly. The theory is just that regulations and market needs open the door for these older practices to become more formalized, more visible, and, much bigger.
Right. That historical context is crucial. Okay, let's move to a big one. Myth number 3, systemic risk. Is the massive growth here creating a danger for the whole financial system?
That's the billion-dollar question, isn't it? The fear of instability.
Understandable.
But the evidence, at least according to this article, suggests maybe not, or at least not yet.
How do they argue that?
Well, they point out that if you look at non-investment grade credit, riskier debt as a slice of the total credit market, that slice hasn't really gotten much bigger over the last decade or so. Stayed pretty stable.
So the growth in private credit isn't necessarily adding more overall risk to the system.
It seems it's growing partly at the expense of other things within that leveraged finance space, like maybe taking share from the high-yield bond market rather than just piling on new risky debt.
Interesting. What about the lending practices themselves? Are they riskier?
Not always. In some areas, like direct lending to smaller, core middle-market companies, the article says you still often find maintenance covenants.
Like leverage covenants. Things borrowers have to continuously meet.
Exactly, which can actually be stricter, more protective for the lender than the incurrence covenants you often see in broadly syndicated leveraged loans now. Those only kick in if the borrower tries to do something specific, like take on more debt.
So maintenance covenants give an earlier warning signal if things start to go wrong.
Potentially, yes. And the data seems to back this up a bit. They cite lower default rates for private credit loans, 1.7%, versus 4.5% for leveraged loans in late 2024.
That's a significant difference.
It is. They also mention a lot of liability management exercises, LMEs, in the leveraged loan market late last year, which might suggest more stress in that segment.
So the theory is private credit is filling gaps, and in some cases might even be using more conservative structures.
That seems to be the argument for certain segments. The potential downside, though, is obvious.
Right.
It is growing fast, and it is less transparent than public markets.
Yeah,
So you absolutely need ongoing monitoring. Vigilance is key.
right. Can't get complacent. Okay, myth number 4. Private credit is just a beta play, meaning all lenders are basically the same. Returns just follow the market. There's no real skill involved.
Yeah, the idea that it's just one monolithic thing. But that's really not accurate, especially now.
How so? What differentiation are we seeing?
Within direct lending, there's a growing split based on the size of the borrower. Upper middle market, the bigger companies, you've got fierce competition with traditional syndicated loans.
Which means what for lenders?
Pressure on spreads, so lower potential returns and looser terms, meaning maybe more risk for the same price.
Okay, so that end is getting crowded. What about the other end?
The core middle market, smaller borrowers, that's where the article suggests there are still inefficiencies. You might get stronger covenants, potentially better relative performance, and lower defaults historically.
So manager skill really matters there. Choosing the right deals, structuring them well.
Absolutely critical. The article stresses this. As we move away from that easy money period, credit selection, structuring, managing the portfolio risk that becomes paramount. It's not just about riding a wave.
Do they have any examples of this differentiation?
They use BDC's business development companies as an example, looking at their exposure to PIK loans.
PIK, payment in kind, where interest is paid with more debt instead of cash.
Exactly. It can be a sign a borrower is struggling with cash flow. And the range across BDCs was huge, from 4% PIK exposure up to 16% as of late 2024.
Wow, that's a massive difference. Suggests very different underwriting standards.
Precisely. So the theory is, especially in tougher times or less efficient market segments, the skill of the lender in picking and managing loans is a huge driver of performance.
The downside for investors, though.
Yeah, the downside is it can be hard to tell from the outside who's really skilled in doing the work properly. It requires deep due diligence on the manager.
Makes sense. Okay, final myth, number 5. All private credit offers is subordinated capital, meaning it's always the riskiest slice of debt at the bottom of the pile.
Another common oversimplification. Yes, some private credit is subordinated, higher risk, higher yield. That's definitely part of the market.
But not all of it.
Not at all. A surprising amount of private credit is actually investment grade.
Really? Investment grade and private credit, where would we find that?
Think about asset-backed lending, ABL, or private credit, CLOs, collateralized loan obligations. In CLOs, through the magic of securitization, a lot of the tranches investors buy are rated investment grade.
Okay.
Even those SRT deals we mentioned earlier. They can be structured to include senior non-subordinated pieces.
So the theory is just that private credit is broader than people think.
Much broader. It serves different borrowers, different risk appetites. It uses lots of different tools, senior debt, junior debt, asset-backed structures, securitization, to provide capital all up and down the balance sheet.
Not just the riskiest stuff.
Not just the riskiest stuff. Of course, the downside is you do need to understand which part of the market you're looking at. Some strategies are focused on that higher risk end. Know what you're getting into.
So wrapping this up, private credit seems much more nuanced, much more established, and more varied than these common myths suggest.
Definitely. We've seen it's often collaborative with banks, not just competitive. It has deep historical roots. It doesn't seem to be driving systemic risk currently. There's real differentiation between lenders and strategies. And it's not all just subordinated debt. There's plenty of senior and investment grade exposure too.
So given all that complexity and variety, what's a big takeaway for you? What should people really be thinking about?
For me, it boils down to needing a really granular approach. You can't just slap the label private credit on something and think you understand it.
You need to dig deeper.
You absolutely have to dig deeper. Look at the specific strategy, the manager's expertise, who they're lending to, the terms, the market niche. What about you? What strikes you most?
I think it's that point about skill becoming even more important now. Inefficiencies exist, especially in certain segments, and finding managers who can navigate that, particularly if the economic environment gets tougher, seems crucial. It's not a passive investment.
Well said.
Thanks for walking through these myths with me. It certainly clarified things.
My pleasure. Good discussion.
And thank you for joining us. Hopefully this gives you a more nuanced view of private credit. We'll leave you with a final thought. Given this complexity, what are the most critical factors for anyone, individuals, institutions to weigh when looking at this asset class, whether for investment or just understanding its economic role? Something to ponder. Until next time.